The banking sector has come back quite some way since over the last 18 months, which I think, first of all, was a lesson to those that said, dividends are safe in my franking and therefore I will always stay in my banks. We've got a bit of a wake-up call that that's not necessarily always the best idea. So all the benefits of dividend franking have been dissipated by declines in the share price. The banking system, I think, is actually quite a difficult one to judge because based on sort of historic valuations, it's really not as appropriate as what it was because the capital ratios in the banks are completely different to where they previously traded at. So there's no going back to bank valuations. Our banks are expensive compared to global banks. So by and large, we are, if you like, taking a benign view in the banks at the moment. They're neither saying you should be buying them right now or selling them. They do play a fairly decent role in terms of dividend delivery. It doesn't look like that's likely to be immensely compromised in the near term, albeit that I think it's become very clear that dividend growth will be very limited. So it's very important that the portfolio is balanced out by other things which have got dividend growth potential, capital growth potential as well. Particularly if you're taking the dividend out, remember your investment returns in the Australian market are substantially lower because we have such a higher payout ratio. The resource sector looks like it's bottomed, mostly because of the way that the resource companies have dealt with their cost ratios. So that gives one a much better buffer than what they were like as well, let's say 2 years ago. But you will still be beholden to some of those issues that we can't be sure about what will happen in China. Just in this last week, we had issues about the steel market, the excess capacity in the steel industry there, what impact that might have on the iron ore price. It certainly looks like it'll keep a lid on it. I think it'd be remiss for Australian portfolio not to have some resource exposure. It's always a question of not just drawing a hockey stick approach and letting it ride on forever, but they probably are okay value at the moment. To be honest, it's become considerably harder. So we've had around about a year of the yield trade or the bond trade. So your REIT sector, your listed infrastructure stocks, all these kind of companies which are paying out bond-like yields have rallied very, very hard to even the insiders running the money believe that the vast majority of those stocks are overpriced at this point in time. On the other hand, you've had your dollar stocks, the ones that had exposure to the US dollar, also rallied as the Australian dollar fell, and now we're back to sort of the reality of their underlying growth characteristics. And it does feel like the more interesting part of the market therefore resides in those kind of companies that have got some growth potential, but are not in those two sectors. Unfortunately, they're extremely expensive. Your Domino's, your Ramsay Health Care, etc., which are interesting companies from a long-term perspective in terms of what they've been able to achieve, but you're paying eye-popping multiples for them, which makes it very, very hard. So now you're down to looking at, do you believe that there could be a cyclical upswing here? And you could be, your sort of retail, your home builders might stretch their capacity for profitability. That you're getting into sort of a higher risk judgment call of the market. So some of the mining services companies, which also have been downgraded heavily, they're starting to look a little bit more interesting again as the mining industry itself becomes more. But as I said, you really, there's no question that you're going into a higher risk end of the market than most people typically are comfortable with. And that's where I think that sort of, if you like, professional oversight becomes increasingly critical.